Here's something genuinely strange about where we are right now. Gas prices are at 4-year highs. The 10-year Treasury yield just had its worst week in 12 months. Consumers in a New York Fed survey expect inflation at 3.6% a year from now. And at the exact same time, the exact same week, the Dow closed above 50,000 for the first time in its history. The S&P closed above 7,500. Both of those things are true simultaneously, which means either the bond market is panicking about something the stock market hasn't noticed yet, or the stock market is betting on something the bond market doesn't believe. One of them is probably wrong. Maybe both of them are. What I want to do tonight is trace the chain that connects all of it, from a waterway most people couldn't find on a map, to the price of your last fill-up, to something much larger that almost nobody is saying clearly right now. My name is James Whitmore. Let's go. Start with Hormuz, because that's where the chain starts. The Strait of Hormuz is about 34 kilometers wide at its narrowest. Through that 34 kilometers passes roughly 1 in 5 barrels of oil consumed on Earth, plus a huge share of global liquefied natural gas. There's no easy detour. When Iranian forces effectively blocked transit after the US and Israeli strikes in late February, and the US besieged Iranian ports in response, shipping through that channel didn't slow. It basically stopped. UBS put a number on it. Observed global oil inventories fell by 246 million barrels across March and April. The bank estimates cumulative production losses could top 1 billion barrels by the end of this month. And Saudi Aramco, the largest oil company on Earth, warned that full normalization of Middle East supply might not come until 27. Not next quarter. Not after the deal gets signed. 2027. Even in the best case, the damage is already baked in. You don't undisrupt 1 billion barrels with a press release. And you felt it. Brent crude touched $118 a barrel at the worst of it. West Texas settled near $107. National gas prices hit 4-year highs heading into Memorial Day. Pump prices in the US have been running roughly $1.50 above where they were before this war started. And here's the thing about energy prices. They don't stay at the pump. They move. Food delivery costs more because the trucks that carry food run on diesel. Airfare costs more because planes run on jet fuel. Retail shipping, utility bills, every business that uses energy to make or move anything, they all did what businesses always do with higher costs. They pass them straight through to you. Now, as I'm recording this, oil has actually come back down. WTI settled below $89 after Iranian state media put out a report suggesting Tehran would restore Hormuz traffic to pre-war levels within a month of any deal. Markets cheered. The Dow set a record. Everyone exhaled. Then the White House called the report a complete fabrication. So that's where we are. The price of oil, and by extension the price of nearly everything, is moving 5% in a single session based on whether a peace rumor is real or planted. One headline says deal, the next one says it never existed. And between those two sentences, billions of dollars change hands. That's not a stable market. That's a market holding its breath. If you're finding this useful, this kind of analysis that connects what's happening in the Gulf to what's happening in your wallet, subscribing takes 2 seconds and means you won't miss when the next piece of this story breaks. Which it will. Buttons right there. Here's what I find genuinely unsettling about the bond market reaction, because I think it's the part that isn't getting enough attention. A few weeks ago, US government debt had its worst weekly performance in a year. The 10-year Treasury yield jumped to around 4.6%. The 30-year climbed to levels it hadn't seen since 2023. And this wasn't just an American story. Yields surged in Japan, Britain, Germany, basically everywhere at once. Because investors across the world looked at an oil spike driven by a war and came to the same conclusion. Inflation is coming back, and central banks may not have the room to cut that everyone was expecting. That matters enormously for your actual life, not just for traders. The 10-year Treasury is the benchmark underneath your mortgage rate. It's also under car loans, business loans, and the US government's own cost of rolling over its debt. When that yield jumps, borrowing costs go up across the entire economy. And here's the uncomfortable corner the Fed might be walking into. Slowing growth on one side. Sticky, energy-driven inflation on the other. That combination has a name that haunted an entire generation of Americans in the 1970s. Stagflation. The economy stalling and prices rising at the same time, the one combination central banks have almost no good tools to fix, because every lever they pull to solve one problem makes the other one worse. Cut rates to help growth, you feed inflation. Raise rates to kill inflation, you choke off growth. Futures markets are now pricing something like a coin flip chance the Fed actually hikes by December. The entire direction of monetary policy, which was supposed to be toward cuts, got reversed by a 34-kilometer waterway in the Persian Gulf. And yet, the stock market is at record highs. I want to be honest with you about what that actually means, because the easy interpretation is that one side is right and one is wrong. I don't think it's that simple. Markets at record highs don't mean everything is fine. They mean the market has made a bet. Specifically, a bet that this oil shock ends soon, that the deal gets signed, that AI profits keep flowing, and that the whole thing resolves before inflation fully escapes. Wall Street is pricing in the best case. And maybe they're right. Markets have a decent track record of pricing these things correctly. But here's what makes me uneasy. Those records aren't built on solid fundamentals. They're built on an assumption about a war. And that assumption has already cracked and been rebuilt 4 or 5 times this spring. Oil drops on a rumour, spikes when the rumour dies, drops again when the next one surfaces. One bad headline out of Tehran, one tanker hit in the Strait, one collapse in whatever talks are happening this week, and that optimism reprices in an afternoon. Record highs leaning on an on-again, off-again ceasefire is not strength. It's a very expensive hope. Now let me go deeper, because so far I've only described the fire. I want to show you what's burning underneath it. Quick note before this next section, and this is honestly the part most financial coverage never gets to. If you're not subscribed yet, this is the kind of thing you'd want to have in your feed regularly. The geopolitical and financial stories are almost always the same story. That's what this channel is built around. For 50 years, there's been a system holding up American financial power that most people have never spent a minute thinking about. It's usually called the petrodollar system, and the core idea is simple. The world's oil gets priced and sold in US dollars. Saudi Arabia sells a barrel of oil. The buyer pays in dollars. Every country on earth that needs energy, which is every country, therefore needs to hold dollars to buy it. And the surplus dollars that oil producers earn, a lot of them get recycled back into US assets, especially US government debt. Follow that loop. Global demand for oil creates global demand for dollars. Global demand for dollars creates global demand for US treasuries. And that constant structural appetite for American debt is a big part of what lets the United States borrow at a scale no other country could manage, run enormous deficits, fund its military, maintain the dollar as the world's reserve currency. Oil holds up the dollar. The dollar holds up the debt. The debt holds up the power. So here's the question the Hormuz crisis is really raising. What happens if more oil starts getting priced and settled outside that loop? That's the actual game being played behind the missiles. Iran, with backing from China and Russia, has every incentive to push energy trade out of the dollar system, partly ideological, mostly practical. Iran is locked out of the dollar-based financial system by sanctions anyway. For Tehran, using yuan or rubles or anything else isn't a geopolitical statement. It's just survival. And for China, the world's largest oil importer, reducing exposure to a currency Washington can weaponize is straightforward strategic logic. And it's not just theory. China launched yuan-denominated oil futures in 2018. PetroChina has settled cross-border purchases in digital yuan. China and Russia now conduct the bulk of their bilateral trade in their own currencies, bypassing the dollar. India has bought Russian oil in rupees. And when the West froze roughly $300 billion of Russia's central bank reserves after the Ukraine invasion in 2022, it sent a message that every government outside the Western orbit heard clearly. Dollars in the system can be turned off. And nothing motivates a country to find an alternative faster than watching someone else's savings get switched off with the flip of a switch. Now, and this is where I want to slow down, because this is exactly where these conversations go off the rails. The dollar is not collapsing. I want to say that plainly because the internet is flooded right now with people telling you the petrodollar is dead, the system is finished, buy gold and crypto before it's too late. And the honest data doesn't support that. The yuan's share of global payments through the SWIFT system sits at roughly 2.5 to 3%. 3%. And a substantial chunk of even that small slice is China-Russia bilateral trade that exists specifically because of sanctions, not because anyone genuinely prefers the yuan as a settlement currency. The dollar remains the most liquid, most trusted, most widely held currency on the planet by an enormous margin. Serious analysts, including the Asia Society, which has studied this carefully, conclude that complete de-dollarization of the oil trade is highly unlikely over the next 5 years. What they expect is gradual erosion. A slow leak, not a sudden burst. So why does this matter if it's not imminent? Because the doomsellers and the dollar cheerleaders are both making the same mistake. They're treating it as binary. Either the dollar reigns supreme forever, or it collapses next week. The actual story is neither. The actual story is direction. Every sanction that freezes a country's reserves, every barrel that settles in yuan, every central bank that quietly adds gold instead of treasuries, none of those events ends the dollar. All of them, together, over time, change the slope of the curve. And what the Hormuz crisis does, what it really does in the long game, is give every country sitting on the fence a fresh reason to reduce its exposure to a system that can be disrupted by American foreign policy choices. That's what should give you pause. Not that the dollar dies this year, but that the events of this spring may be quietly accelerating a trend that 10 or 15 years out leaves the US borrowing in a world that needs its currency just a little bit less than it used to. Picture what even a modest erosion in global appetite for US treasuries looks like while the US is running enormous deficits and rolling over tens of trillions in debt. Who buys those bonds? At what interest rate? You may have to offer higher yields to attract buyers. Higher yields mean higher interest costs on the debt. Higher interest costs eat the budget. And the pressure compounds year after year. That's not a collapse. It's something slower, and arguably more dangerous because it's harder to see and harder to stop. Let me bring it back to something concrete. Here's the chain, start to finish. A 34-kilometer waterway gets squeezed. Oil spikes to $118. Gas hits 4-year highs and stays $1.50 above where it was. Inflation expectations climb. Bond yields jump. Your mortgage gets more expensive. The Fed gets trapped between two bad options. And the same crisis pushes oil-producing nations towards settling trade outside the dollar, which, over the long run, chips at the very foundation that lets America borrow cheaply and project financial power. Every link in that chain is real. Every link is visible right now in public data. And here's what I want to leave you with, because I've spent this whole video resisting the easy doom, and I want to keep doing that to the end. The United States is not finished. American markets are at record highs. American technology is leading an AI revolution that is genuinely transforming industries. The dollar is still the deepest, most trusted currency on earth by an enormous margin. None of that is fragile in the way the panic merchants claim. But strength and trajectory are two different things. A runner can be in first place and slowing down at the same time. The question this war is forcing, the real question underneath the oil price and the bond yield and the petrodollar, isn't whether America is strong today. It obviously is. The question is whether the system that made it strong is quietly being rewired by 1,000 small decisions from 1,000 different actors, each one of them reasonable on its own, each one nudging the same direction. And if the foundation of American financial power is the thing nobody thinks about until it's under stress, what does it tell you that suddenly everyone is thinking about it? Last thing before I go. If this gave you a clearer picture of something you felt but couldn't quite put into words, that's exactly what I'm trying to do every week. If that's worth having in your feed, subscribe and hit the bell. You'll have the context ready the next time a headline drops that doesn't quite add up. This is James Whitmore. I'll see you in the next one.